Hello. Okay, today we're going to be talking about credit spread risk in the banking book, CSRBB. Now, credit spread risk in the banking book is one element of the interest rate risk in the banking book regulation that banks, which operate in a Basel framework, which most countries do, which practically all countries do, banks have to follow IRRBB regulation, and one of the elements of IRRBB is this one, credit spread risk in the banking book. Now, what does that refer to? That refers to exposure, risk, balance sheet exposure, risk exposure of the present value of your balance sheet assets changing because the credit spread, the credit premium of your loan assets, your credit risky assets, changes. Okay, it's quite arcane and the regulation on it isn't entirely clear. And so different countries have implemented the Basel guidance in slightly different ways. So I'm going to talk you through an explanation of what Basel meant, and then you can determine to what extent you think your bank needs to follow this guidance and talk about it in your ICAP. And I'm sure there's a video on ICAP somewhere here on this channel. Right, so credit spread risk in the banking book. Let's start from the beginning. If we imagine we have this yield curve and the government rate or the risk-free rate, and no need to write in about this, whether it's really risk-free or not, let's just call it that. The sovereign bond yield curve looks like that, and the bank's own cost of funds is that. This difference between those two rates reflects two things. It reflects a TLP, a term liquidity premium, and the bank's own credit risk. Okay, if you lend money to the central bank of your country, they will pay you a lower rate, where they pay on reserve balances at all, than if you lent money to a customer who has a higher credit risk than your central bank. So the credit risk is the premium, credit risk of any borrower is the premium that a lender charges for lending money to it. And that's a part of the overall spread over the risk-free rate. So there's two elements to it, the term liquidity premium and the credit risk. Okay, so that is how much a bank adds on to a borrower to its own funding rate, its own cost of funds for lending money to that customer. Credit spread risk refers to the fact in this legislation, credit spread risk in the banking book, refers to the fact that you've got, leave that box for a second, you've got credit spread risk on the balance sheet, and if the credit premium of your customer loan book changes for the worse, the present value, the implied present value of that loan book will drop. That's basically what CSRBB refers to. But it refers only to the credit premium, the credit quality of that loan book changing. It doesn't refer to the overall rates that a borrower would pay changing, because that includes TLP, term liquidity premium. And the original Basel guidance said we were to strip that out. We can't observe pure credit risk, the price of pure credit risk in the market from borrowing rates of customers. We can infer it by comparing it with the credit default swap market, but that's not a universally reliable guide. So we will need to determine how much our credit risky loan book, our customer loan book, and indeed our bond portfolio, changes in value when the credit quality of that loan book changes short of default. Okay, and the European Banking Authority, the EBA's legislation on this following Basel guidance, referred to the whole portfolio. Think of this as the assets on the balance sheet, the credit risky assets, and the whole portfolio changing in credit quality, not just individual loans. So let's say you had loans to different customers here, and they amounted to 100, that's meant to be euros, 100 million euros. How much would the deterioration of credit quality of that 100 million loan book, how much would that affect the present value of that loan book? Separate from how much the present value will change because interest rates change. So we're interested in, let's just imagine in a theoretical situation, we're interested in market rates being unchanged. There's no change in your cost of funds, no change in bank base rate, no change in the yield curve generally, but there's been a deterioration in credit quality of your loan portfolio, your bond portfolio, short of default, okay? So if we were to observe that, we would calculate the present value of the balance sheet of that loan portfolio and see what it would be, how it would be different if there was a worsening of the credit quality of that loan book, and then that would be, if you like, our delta CSRBB. Okay. Now there is actually an accounting guide, an international accounting rule called IFRS 9 that obliges banks to do this calculation or this estimation anyway, a forward-looking view of the deterioration of credit quality of my loan book, and provision for it, set aside capital for it. I shouldn't use that expression, set aside, because capital is a liability, not an asset. But they need to appoint or assign capital to address expected worsening of the credit quality of the loan book. Okay, that's IFRS 9. This is different. This is part of IRRBB legislation. So we would look at the credit risky loan book. So in other words, all loan assets that are bonds or debt or customer loans that aren't risk-free, credit risk-free, and we would determine what a deterioration of credit quality of the loan book, the whole portfolio, would mean for the present value of that portfolio should there be a change in the credit quality. That's CSRBB. If we determine under a scenario where if that worsened by, say, 100 basis points, the present value would go down by X million, if we determine that as a scenario, the legislation suggests that we would then assign capital to this equivalent amount to our capital base as additional capital to address this CSRBB risk. Okay, so that in a nutshell is CSRBB, but as I said, the guidance around it isn't as clear as one might have expected, and so there isn't uniformity on how this is approached in banks around the world. But there's a good starter for you. Thank you for watching. See you soon.